Today, I'm going to share a game-changing insight that transformed my financial life and has the potential to do the same for you. It's not just a secret, it's a mindset shift, a perspective that has the power to unlock doors to prosperity. So, buckle up and get ready to discover the key that turned my journey from financial struggle to abundance. I got rich when I understood this, and now, it's time to pass on the knowledge that can reshape your financial future. Warren Buffett, one of the most successful investors of all time, has shared various pieces of advice over the years. Long-term perspective, Buffett is known for his long-term approach to investing. He advises investors to think of stocks as businesses and to focus on their underlying value over time. Value investing, Buffett follows the principles of value investing, which involves finding companies that are undervalued by the market. He looks for strong fundamentals, including a competitive advantage, solid management, and a reasonable price. Margin of safety, Buffett emphasizes the importance of having a margin of safety when making investments. This means buying stocks at a price significantly below their intrinsic value to protect against unforeseen market fluctuations. Understand what you invest in. Buffett suggests that investors should only invest in businesses they understand. He often warns against investing in things that are too complex or outside one's circle of competence. Quality over quantity, Buffett is known for concentrating his investments in a relatively small number of companies that he thoroughly understands. He believes in quality over quantity when it comes to building a portfolio. Be fearful when others are greedy, and greedy when others are fearful. This famous quote highlights Buffett's contrarian approach to investing. He suggests that investors should take advantage of market opportunities when others are panicking or overly optimistic. Remember that while these principles reflect Buffett's general approach, successful investing also requires adaptation to one's own risk tolerance, financial goals, and market conditions. Robert Kiyosaki, the author of the Rich Dad Poor Dad series, is known for his perspectives on personal finance and wealth building. Financial education, Kiyosaki places a strong emphasis on financial education. He suggests that individuals should continuously learn about money, investing, and how to make their money work for them. This education includes understanding assets, liabilities, and the importance of cash flow. Invest in assets, Kiyosaki distinguishes between assets and liabilities. He encourages people to focus on acquiring income-generating assets, such as real estate or investments, rather than accumulating liabilities, which are things that take money out of your pocket. Entrepreneurship, Kiyosaki advocates for entrepreneurship as a means of building wealth. Starting and owning a business can provide individuals with control over their financial destiny and the potential for unlimited income. Mindset shift, Kiyosaki often talks about the need for a mindset shift, particularly in how one views money and wealth. He challenges the traditional mindset of working for a paycheck and encourages people to think like investors and business owners. Taking calculated risks, Kiyosaki believes in taking calculated risks to achieve financial success. This includes being willing to step outside of one's comfort zone and explore opportunities that have the potential for significant returns. Multiple streams of income, Kiyosaki promotes the idea of having multiple streams of income. Relying solely on a job may not be sufficient for building lasting wealth, and having diverse income sources can provide financial stability. It's important to note that while Kiyosaki's teachings have resonated with many, financial success is a complex and individual journey. Not all financial advice is one size fits all, and individuals should carefully consider their own circumstances, risk tolerance, and financial goals. Jeff Bezos, the founder of Amazon and one of the wealthiest individuals globally, has shared various insights and principles throughout his career. Customer-obsessed approach, Bezos emphasizes the importance of focusing on customers. Long-term vision, Bezos is known for his long-term vision and willingness to invest in projects that may not show immediate returns. This approach has allowed Amazon to innovate and expand into various industries over time. Innovation and experimentation, Bezos encourages a culture of innovation and experimentation. He believes in taking risks and learning from failures, viewing them as essential steps towards success. Frugality, despite Amazon's massive success, Bezos has advocated for frugality and efficiency. He has often stressed the importance of being cost-conscious and avoiding unnecessary expenditures. Focus on what won't change, Bezos has spoken about the importance of focusing on fundamental principles that are unlikely to change over time. This approach can guide decision-making and strategy in a rapidly evolving business environment. Day one mentality, Bezos coined the term, day one, to express the idea of maintaining an entrepreneurial mindset, even as a company grows. It reflects a commitment to staying agile, innovative, and customer-focused, as if it was still the first day of operations. While these principles capture some of the key elements of Bezos's business philosophy, it's important to note that success is often a result of a combination of factors, timing, and circumstances. Peter Lynch, another highly successful investor, is known for his tenure as the manager of the Fidelity Magellan Fund and his book, One Up on Wall Street. Lynch has shared several principles that investors can consider to potentially outperform the majority of investors. Invest in what you know. Lynch often advises investors to focus on companies and industries they understand. If you're familiar with a business and its products or services, you may have an advantage in evaluating its potential for success. Long-term perspective. Like Warren Buffett, Lynch is an advocate of long-term investing. He suggests that investors should be patient and not be swayed by short-term market fluctuations. Look for growth opportunities. Lynch is known for his emphasis on investing in companies with strong growth potential. He recommends looking for companies that have a competitive edge, a solid growth strategy, and the potential for increasing earnings over time. Understand the business model. Lynch advises investors to thoroughly understand the business model of the companies they invest in. This includes understanding how the company makes money and how sustainable its competitive advantages are. Keep an eye on P/E ratios. Lynch often looked at the price-to-earnings (P/E) ratio of a stock to evaluate whether it was overvalued or undervalued. However, he also cautioned against using this metric in isolation, as context is crucial. Stay informed. Lynch encourages investors to stay informed about the companies they invest in and the overall market. It's crucial for investors to conduct their own research, consider their risk tolerance, and, if needed, seek advice from financial professionals. Additionally, past performance does not guarantee future results, so it's essential to stay vigilant and adapt to changing market conditions. Dave Ramsey is a personal finance expert, author, radio show host, and motivational speaker known for his straightforward advice on managing money, getting out of debt, and building wealth. His teachings are based on a set of principles that promote financial responsibility, debt reduction, and long-term wealth building. Debt snowball. One of Ramsey's well-known strategies is the debt snowball. This method involves paying off debts in order from smallest to largest, regardless of interest rates. The idea is to gain momentum and motivation by achieving quick victories with smaller debts, then applying those payments to larger debts. Emergency fund. Ramsey emphasizes the importance of having an emergency fund to cover unexpected expenses. This fund acts as a financial safety net and can prevent individuals from relying on credit cards or loans during emergencies. Live on a budget. Ramsey encourages individuals to create and stick to a monthly budget. This involves tracking income and expenses, allocating funds for different categories, and prioritizing needs over wants. Cash envelope system. To control spending, Ramsey recommends using the cash envelope system. This involves allocating specific amounts of cash to different budget categories and only spending the cash available in each envelope. It helps promote discipline and prevents overspending. Investing for the future. Ramsey advises on investing for long-term wealth building. He suggests focusing on tax-advantaged retirement accounts, such as 401ks and IRAs, and diversifying investments in a mix of mutual funds with a history of solid returns. Live below your means. Ramsey promotes a lifestyle of living below one's means. This involves avoiding unnecessary debt, making conscious spending decisions, and saving and investing for the future rather than succumbing to a high-consumption lifestyle. Financial Peace University. Ramsey offers a program called Financial Peace University, which provides education and tools for individuals and families to take control of their finances. The program covers topics such as budgeting, debt reduction, investing, and retirement planning. Dave Ramsey's advice is often delivered through various channels, including his radio show, books, and online resources. As we wrap up this eye-opening journey, remember that wealth isn't just about money, it's about mindset. Embrace the power of this understanding, incorporate it into your financial strategy, and watch the transformation unfold. Your financial success story is unique, and the key to unlocking it lies in the decisions you make today. I got rich when I understood this, and now, armed with this knowledge, I challenge you to embark on your own journey to financial freedom. Here's to your prosperity and a future filled with abundance. Make it happen by putting your money to work in various assets, such as stocks, bonds, or real estate. You have the potential to grow your wealth and achieve financial goals. Compound growth. The power of compounding is a significant advantage of investing. As your investments generate returns, those returns can, in turn, generate more returns. Over the long term, compounding can significantly boost the value of your investment portfolio. Income generation: certain investments, such as dividend-paying stocks or rental properties, can generate a regular income stream. This passive income can provide financial security and support your lifestyle. Warren Buffett, one of the most successful investors of all time, is known for his straightforward and disciplined approach to investing. While he may not explicitly list 7 rules, he has shared a set of principles and guidelines over the years. Here are 7 key principles often associated with Warren Buffett. Invest in what you understand. Buffett emphasizes the importance of investing in businesses and industries that you understand well. Stick to your circle of competence and avoid making investments in areas you don't fully comprehend. Long-term perspective: Buffett is a proponent of long-term investing. He believes in holding onto investments for an extended period, allowing them to grow and compound over time. Patience is a key element in his investment philosophy. Economic moats: Buffett looks for companies with a durable competitive advantage or an economic moat. These are businesses with strong brand recognition, low-cost production, or other factors that make it difficult for competitors to challenge them. Quality management: Buffett places a strong emphasis on investing in companies with trustworthy and capable management. He looks for leaders who are both competent and honest in their dealings. Margin of safety: Buffett advises investors to buy stocks when they are priced below their intrinsic value. This provides a margin of safety, protecting against potential downturns in the market. Focus on intrinsic value: Buffett evaluates investments based on their intrinsic value rather than short-term market fluctuations. He often looks at a company's fundamentals, cash flow, and future growth prospects. Be fearful when others are greedy, and greedy when others are fearful. This famous Buffett quote suggests that investors should be contrarian. When the market is overly optimistic and prices are high, it might be a signal to be cautious. Conversely, during times of fear and low prices, it may present buying opportunities. It's essential to note that while these principles are associated with Buffett, successful investing requires careful consideration of one's own financial goals, risk tolerance, and market conditions. Additionally, Buffett's investment strategy has evolved over time, and he often emphasizes that his approach may not be suitable for everyone. In the context of mistakes to avoid in investing, here are some points often attributed to Warren Buffett. Lack of research and understanding: avoid investing in companies or industries you don't fully understand. Conduct thorough research to comprehend the business, its competitive position, and its future prospects. Trying to time the market: Buffett advises against trying to predict short-term market movements. Instead, focus on the long-term fundamentals of the companies you invest in. Overlooking quality management: don't underestimate the importance of trustworthy and competent management. Quality leadership is a crucial factor in the success of a company. Ignoring economic moats: look for companies with a competitive advantage or economic moat that can protect them from competition. This helps ensure long-term sustainability. Not having a margin of safety: avoid buying stocks at prices significantly above their intrinsic value. Building in a margin of safety can help protect your investments during market downturns. Emotional decision-making: Buffett advises against making investment decisions based on short-term market sentiment or emotions. Maintain a disciplined approach and stick to your investment strategy. Chasing performance: don't follow the crowd or chase the latest investment trends. Evaluate investments based on their fundamentals rather than trying to catch the next hot stock. Overtrading and high transaction costs: Buffett emphasizes the importance of patience and holding onto investments for the long term. Excessive trading can lead to higher transaction costs and may not be conducive to long-term wealth creation. Focusing on short-term performance: avoid getting overly concerned with short-term fluctuations in your portfolio. Buffett's emphasis is on long-term performance, and he often disregards short-term market noise. Not learning from mistakes: learn from your investment mistakes. Buffett acknowledges that everyone makes errors, but the key is to understand them and avoid repeating them in the future. Remember that investing involves risks, and individual circumstances vary. While these principles are associated with Warren Buffett, it's essential to adapt them to your own financial situation and risk tolerance. Here are additional rules or principles associated with Warren Buffett's approach to investing. Long-term ownership mentality: Buffett advises investors to approach the stock market as if they could only make 20 investment decisions in their entire life. This encourages a focus on long-term ownership and commitment to chosen investments. Avoiding debt: Buffett is generally cautious about using borrowed money, leverage, for investing. He recommends avoiding excessive debt, especially when it comes to investing in the stock market. Investing in businesses, not tickers, Buffett suggests thinking of stocks as ownership in businesses rather than just pieces of paper. This mindset shift can lead to more informed and patient investment decisions. Circle of competence. Stick to what you know and understand well. Buffett advises against venturing into areas where you lack expertise, as this can lead to poor investment decisions. Consistency and discipline. Consistency in applying your investment principles is crucial. Avoid being swayed by short-term market fluctuations, and maintain discipline in your investment strategy. Diversification. While Buffett is known for concentrated bets, he also emphasizes the importance of diversification to manage risk. However, he suggests that diversification should not come at the expense of understanding your investments. Quality over quantity. Buffett often emphasizes the concept of wide strikes and few at-bats. In other words, focus on high-quality investment opportunities rather than making numerous, lower-quality investments. Holding cash. Buffett believes in keeping a cash reserve for opportunities that may arise during market downturns. Having cash on hand allows for capitalizing on attractive investment opportunities when others may be selling. Understanding the macro environment. While not a macro investor, Buffett considers the broader economic environment. Understanding the macro trends and potential risks can help shape investment decisions. Continuous learning. Buffett is known for his voracious reading habits. He encourages investors to continuously learn and stay informed about the businesses and industries they are invested in. Remember, these principles are part of Buffett's philosophy, and each investor should adapt them based on their own circumstances and risk tolerance. Here are some life advice principles often attributed to Warren Buffett that can potentially impact your life. Integrity and reputation. Buffett places a high value on integrity. He advises individuals to conduct their lives with honesty and to build a reputation that will be an asset over the long term. Surround yourself with the right people. Choose your friends and associates wisely. Buffett emphasizes the importance of associating with people who have high ethical standards and values. Invest in yourself. Buffett encourages continuous learning and self-improvement. Invest time in acquiring knowledge and skills that can enhance your personal and professional life. Stay humble. Despite his success, Buffett is known for his humility. He advises staying humble and avoiding arrogance, both in success and failure. Live below your means. Buffett is famously frugal despite his immense wealth. He recommends living a modest lifestyle and avoiding unnecessary expenses to build financial security. Choose a career you love. Buffett often suggests pursuing a career that you are passionate about. This can lead to greater job satisfaction and success in the long run. Avoid envy and comparison. Buffett advises against measuring your success by comparing it to others. Focus on your own goals and values rather than being envious of someone else's achievements. Take risks early in your career. Buffett encourages taking calculated risks, especially early in your career when you have less to lose. This can lead to valuable experiences and opportunities for growth. Maintain a healthy lifestyle. Buffett recognizes the importance of physical and mental well-being. Taking care of your health can contribute to a more fulfilling and productive life. Be patient. Patience is a virtue in both investing and life. Buffett often mentions the importance of taking a long-term view and not being swayed by short-term challenges or setbacks. Remember that these pieces of advice are based on Buffett's personal philosophy, and individual circumstances may vary. It's important to interpret and apply them in a way that aligns with your own values and goals. Unlocking the secrets to billionaire wealth creation isn't just about financial wizardry, it's a journey guided by timeless principles. When we delve into the world of Warren Buffett, the Oracle of Omaha, we unearth a blueprint that transcends mere investment tactics. Buffett's strategies aren't just about numbers on a balance sheet. They're a philosophy of patient capital, calculated risks, and an unwavering belief in the enduring strength of businesses. In this exploration, we navigate the terrain of Warren Buffett's investment strategies, the alchemy that transformed a modest investment into billionaire wealth. Warren Buffett is widely regarded as one of the most successful investors in the world. Born on August 30, 1930, in Omaha, Nebraska, Buffett is the chairman and CEO of Berkshire Hathaway, a multinational conglomerate holding company. Buffett is known for his value investing philosophy, emphasizing the importance of investing in companies with strong fundamentals and a long-term perspective. He often seeks companies with a competitive advantage, predictable earnings, and competent management. Buffett took control of Berkshire Hathaway in the 1960s, and under his leadership, the company transformed into a diversified conglomerate with holdings in various industries, including insurance, utilities, energy, and consumer brands. One of Buffett's key principles is to invest for the long term. He is known for holding onto investments for extended periods, often ignoring short-term market fluctuations. Buffett is renowned for his annual letters to Berkshire Hathaway shareholders. These letters provide insights into his investment philosophy, economic views, and perspectives on business. Buffett, along with Bill and Melinda Gates, founded the Giving Pledge, a commitment by some of the world's wealthiest individuals to give away the majority of their wealth to address society's most pressing problems. Buffett's life and investment strategies have been extensively documented in numerous books and articles. His straightforward and insightful quotes on investing, business, and life are widely cited. Buffett emphasizes staying within one's circle of competence. This means investing in industries and businesses that one thoroughly understands. He advocates for focusing on areas where you have a competitive edge in terms of knowledge and expertise. Buffett looks for companies with economic moats, which are sustainable competitive advantages that protect a business from competitors. These could include strong brand recognition, cost advantages, network effects, or regulatory advantages. The concept of a margin of safety is integral to Buffett's approach. He seeks investments where the intrinsic value of a business is significantly higher than its market price, providing a margin of safety against unforeseen risks. Buffett places great importance on the quality of a company's management. He looks for leaders with integrity, a long-term vision, and a track record of sound decision-making. Buffett often invests in companies with capable management teams that he trusts. Before investing, Buffett thoroughly understands the businesses he considers. He reads annual reports, studies financial statements, and seeks to comprehend the core drivers of a company's success. This deep understanding helps him make informed investment decisions. Buffett often goes against market trends and is not swayed by short-term market sentiment. In times of market turbulence, he sees opportunities to buy great businesses at discounted prices. Buffett is generally cautious about using leverage. He prefers companies with conservative debt levels and emphasizes financial prudence. This approach minimizes the risk associated with excessive debt. Despite his success, Buffett is always willing to learn and adapt. He stays informed about industry trends, economic developments, and emerging opportunities, adjusting his investment approach as needed. While these principles capture the essence of Warren Buffett's investment strategies, it's important to note that successful investing requires ongoing learning, adaptability, and a commitment to disciplined decision-making. Multiplying in the context of investment typically refers to generating returns or growing the value of an investment over time. Here are 10 steps to follow for successful multiplication of your investments. Clearly articulate your financial objectives. Whether it's wealth accumulation, retirement planning, or a specific financial milestone, having well-defined goals will guide your investment strategy. Assess your risk tolerance and investment horizon. Different investments come with varying levels of risk, and understanding how much risk you're willing to take can help shape your investment choices. Spread your investments across different asset classes, stocks, bonds, real estate, etc., to mitigate risk. Diversification can help protect your portfolio from the impact of a poor-performing asset. Conduct thorough research before making investment decisions. Stay informed about market trends, economic conditions, and news that could impact your investments. Knowledge is a powerful tool in successful investing. Adopt a long-term perspective. Compound returns can significantly multiply your initial investment over time. Avoid making impulsive decisions based on short-term market fluctuations. Reinvesting dividends and returns can accelerate the growth of your investments. Instead of withdrawing profits, consider reinvesting them to take advantage of compounding. Periodically review your investment portfolio to ensure it aligns with your goals and risk tolerance. Rebalance your portfolio if necessary, adjusting asset allocations based on changes in market conditions or your financial situation. Keep an eye on investment costs, including fees and expenses. Minimizing costs can have a significant impact on your overall returns. Choose cost-effective investment vehicles and be mindful of transaction fees. Consider seeking advice from financial professionals, especially for complex investment strategies or if you are unsure about your investment decisions. A financial advisor can provide personalized guidance based on your unique financial situation. Successful investing requires discipline and patience. Avoid making impulsive decisions based on emotions or short-term market fluctuations. Stick to your investment plan and make adjustments based on a well-thought-out strategy. Remember that all investments carry some level of risk, and past performance is not indicative of future results. It's important to tailor your investment approach to your individual financial goals and risk tolerance. Regularly reassess your investment strategy to ensure it remains aligned with your changing financial situation and market conditions. Diversify your investments across different asset classes to reduce risk and protect against market volatility. Follow Buffett's habit of extensive reading. Stay informed about business, finance, and the global economy. Assess the intrinsic value of an investment rather than being solely influenced by market prices. Approach your investments with the mindset of a business owner. Consider the long-term potential and sustainability of the companies you invest in. Resist the temptation to time the market. Instead, focus on the fundamentals of the businesses you invest in. Practice frugality and live below your means. Save and invest the difference for future wealth accumulation. Patience and discipline are key. Avoid emotional decision-making and stick to your investment strategy. Keep a portion of your portfolio in cash or cash equivalents to take advantage of opportunities during market downturns. Be selective in your investments. It's not about the quantity of investments but the quality. Limit the use of debt in your financial strategy. Buffett has often advised against unnecessary borrowing. Look for investments that offer a competitive edge or a unique advantage in the market. Remember, these tips are influenced by Warren Buffett's principles, and while they can provide valuable guidance, it's essential to tailor your investment strategy to your individual financial goals and risk tolerance. Warren Buffett's famous $114 investment story is a powerful illustration of the principles of long-term investing and the impact of compound returns. Here's a brief overview. In the 1950s, Warren Buffett purchased a stock called Sanborn Map Company for $114 per share. Over the years, the stock's value increased, and in 2002, he sold it for a significant profit. The remarkable aspect of this story lies in the patience and compounding effect of long-term investing. While the specific details can vary depending on sources and the exact timeline, the core lesson is about the power of letting investments grow over time. Warren Buffett's $114 investment turned into a substantial amount due to the compounding of returns over several decades. Compounding effect. As the investment grows, the gains themselves generate additional returns, creating a snowball effect. Buffett's success is often attributed to his focus on quality investments. He looks for companies with strong fundamentals, competitive advantages, and the potential for long-term growth. The $114 investment took decades to reach its full potential, emphasizing the importance of enduring through market cycles. While the specific details of the Sanborn Map Company investment might vary in different accounts, the core message remains consistent. Strategic, patient, and long-term investing can lead to substantial wealth creation over time. This story serves as an inspirational example for investors to consider the power of compounding and the benefits of a disciplined, quality-focused investment approach. Warren Buffett's investment strategies for billionaire wealth creation is grounded in a set of principles that emphasize patience, long-term thinking, and a focus on fundamentally sound businesses. Buffett appreciates companies that pay dividends. He sees them as a signal of a company's financial health and a commitment to returning value to shareholders. Buffett sees economic downturns and crises as opportunities to find high-quality businesses at discounted prices. His contrarian approach involves capitalizing on market pessimism. As we conclude our expedition through Warren Buffett's investment strategies for billionaire wealth creation, it becomes evident that his approach isn't merely about financial gain, it's a narrative of prudence, patience, and profound understanding. In the ever-evolving landscape of finance, Buffett's principles stand as pillars, inviting aspiring investors to embrace a mindset that transcends market fluctuations. The journey to billionaire wealth creation, as defined by Warren Buffett, isn't just a financial trajectory. It's a philosophy of enduring value, resilience, and the art of compounding success over time.